What's up guys, it's Andrew here from Pennant Players back with another video. Today we're going to be going over the short squeeze and how to use it in your trading. It can be something that can be very useful in your trading, and we're going to be going over what it is and how to incorporate it. Okay, so without further ado, let's get into the video. So here I've set up a little drawing and we're just going to take a look at what the short squeeze actually is, because it is fundamental to understand the backing of these moves before you actually know how to play them. So what is a short squeeze? Well, essentially, the short squeeze is a compounding of buyers. And, well, why would you say it's a short? Well, first we need to understand what a short is. So what is a short? It's essential to understand what a short is before you can understand the short squeeze. Well, a short is to essentially bet that the price of a share, so say this is the pattern, you're essentially betting that the price is going to go down. Typically, in the stock market, you buy stocks and then you'd sell them for more. This is betting that the stock is bullish, okay? So you buy a stock and then you sell it for more. That's the traditional idea. However, there is something called shorting, where you're essentially borrowing shares to buy at a later date, if that makes sense. But the essence of it is that you are betting that the share, the price of the share will go down. You're betting that it is bearish, and you can make money off doing so. Okay, so essentially what this shorting process, where again, it is essentially borrowing shares to be bought at a later date, because then the price will decrease in theory, which is what you want to happen if you're shorting, and then you can buy at that lower price, is essentially what's taking place. So because of the shorting process, the only way to exit a short position would be to buy. So what's going to happen with shorts is that if you want to, if say you're bleeding money, say this is the chart, and you think right here at this point that the trajectory is going to go down, you're bearish, so you short the stock, but it tends, or sorry, say it actually goes up instead of going down, and you're losing money, and your exit point was here. You say, if that's it, I'm cutting my losses here. Well, what's going to happen here is that you're going to have to buy into this here. So you're not just like selling because you're shorting. So in order to exit the position, you're going to have to buy. So let's understand here before that's just a basis of the short. We need to understand also what makes the share price go up. Well, what's making the share price go up is there is more buyers than sellers. Essentially, that's just what's taking place. There's more shares being bought, rising the price instead of people selling or shorting. So what's going to happen is that, so right here, say this is the chart. At this point, say a lot of people buy. This is going to create the price to go up. So there's many more people buying than selling, is essentially what's going down. So the more buyers, the more shares are being bought as opposed to sold at higher and higher price levels. That's what's taking place in order to create this upward movement. So, well, how does this pertain to the short squeeze? Well, essentially, what the short squeeze is at this point, right here, if there's a bunch of shorts here saying the price is going to go down, but there's more buyers, there's more buying than there is selling, causing the price to go up. So the price actually goes up, but these shorts here thought it would go down. Well, what's the only way to exit their position? The only way to cut their losses, the only way for the shorts to cut their losses and exit that position would be to buy. So again, the only way to exit a short position is to buy. So they're going to have to buy at this price level, thus creating an even greater increase because they are now turning into buyers. So say you have 10 buyers right here. 1, 2, 3, 4, 5. And say they're all, trading the exact same like shares and, price. Obviously, in theory, it's much more simple than in practice because there's going to be many more different variables. However, let's say that they're purchasing the exact same amount of shares at the same price levels and what have you. Say you have 5 buyers right here. And then you have 3 buyers selling, or 3 buyers selling and shorting. So what's going to happen is these people are going to win that battle. So in order for the price to remain stagnant, in order for it to consolidate, you're going to have the equal amount of both buyers and sellers, or sellers and shorts in this case. So you'd have to have these 5. But say that it's more. So say the buyers have more. Again, this is assuming that they are buying the same amount of shares, which doesn't usually happen. So it's more of a conglomerate of and a mash together of, just the total number of shares being bought versus total. But just for the sake, we're going to use these buyers. So they're buying the exact same amount of shares. If these 5 people versus these 3 people, then the buyers are going to win, and thus creating an increase in price. So we can see that here. We can see that this goes up. At this point, this goes up, and then we're creating this upward movement. So now, what's going to happen with these 3 people? Well, these 3 people lost, but now what happens to the shorts? So the shorts were betting that this was going to go down. So they were essentially saying to buy at that later date. So again, the only way to exit would be to buy. So now the shorts now are saying, whoa, this is too much. We got to cut our losses because the buyers just won that battle, thus increasing the price. So what we're going to see here is another large jump that starts compounding. So now say it keeps going up and going up. So now you get even more buyers. Now you have these, so you had like two of these, or say it was 4 even. So now you have like 3 out of the 4 were shorts, or say. So now you've got, 8 buyers, and then you get even more. So say you get even more buyers because people are seeing the hype. Again, we'll go over an example a little bit later with Tesla, but people are seeing the hype now, so then they're buying, but then people still are shorting it. There's more and more people shorting it because they think it's at its high. They think it's going to go down. They think there's no way this is going anymore. So they short it. And then you get even more shorts that then it keeps going up because there's even more buyers. And then it just keeps compounding because then these people are going to lose and they're going to have to exit their positions. And then these people, these additional new shorts, are going to have to convert into buyers now. So what's going to happen is it's literally just going to keep compounding and compounding and compounding. So the shorts are essentially converting into buyers because they want to stop their losses. And then it just creates this large upward movement in price action. So that's essentially what happens with the short squeeze. The shorts get squeezed, like mango juice over here. So they're not really wanting to lose that much money. So then they're getting squeezed, and then they convert into buyers to exit their position, creating even more buyers than there already was, increasing the price even more than it already was increasing. That's essentially what the short squeeze is, and now how to use it. Okay, so how are we going to use the short squeeze? Well, the short squeeze can be something that's quite hard to identify. Now, you can look at, analytics, you can go into extreme, like, different level of market data to try and find like how many people are shorting, because everything is on public record. These are publicly traded shares, so you can see the buyers, sellers, whatever. But it's important to know that the short squeeze, well, it can happen from time to time, just based on fundamentals. A lot of times it will happen on hype stocks. So something like Tesla um, was a great example of the short squeeze. So we can see earlier here in basically January of 2020, December of 2019, that there was a massive short squeeze that happened. So what went down? Well, as you can see here, the price took a jump here. So in November of 2019, we had a nice little jump, and then it kind of consolidated right here. So, we got a little mixed feelings, because what does consolidation mean? Well, consolidation means there's an equal number of buyers and sellers. No one's really winning the battle. But then we see this jump, then we see this consolidation. But after this is when it really gets interesting. After this consolidation, we see another jump in price. So then at this level right here, people are saying, "Oh, this is too high for Tesla. This is trading at near all-time highs. This is like unprecedented. This isn't going to work. This is far too high. I think it's going to go down, so I'm going to short it." But then there's still more buyers, so the price keeps increasing. So we can see here that this just keeps going up, 16, 20%. So these shorts are losing. So everybody that shorted at this price level is now bleeding money. And there's a larger and larger number of buyers because the price is rising. That's what's causing the rise in prices, the amount of buyers. How many shares are being bought is what's rising the price. So now, well, what's going to happen? They're going to want to get out of the position. So we can see here that this price level just keeps rising. So when they try to cut their losses, when the shorts try to cut their losses, they're just going to add to the level of buyers. So there's already so many buyers, but now you get this whole influx of shorts that must cover their position to stop their losses, creating even more buyers, which then in turn creates even more buyers, because the price just keeps rising and rising and rising. It's like this grand increase that's somewhat irrational. I mean, it's an irrational, erratic price movement, but it's what happens because there's so many buyers, and then that just gets compounded with the amount of buyers being added from the shorts, that then it creates this really large price movement right up. So then, well, what's going to happen here? Everyone's saying, "Oh, this is too high, this is too high," and then people short again. So now that you got even more people shorting here, and then what happens here is that it just keeps going up again. There's still more buyers, so it just keeps going up and up and up. And then these shorts that thought this was going to be the high and it was going to go down here, they cut their losses now too. So now you got even more buyers. So it creates this grand, massive increase in the price action. We could see in just, what was this? 120 days. So in about 4 months, the price of this rose over 150%. And then of course it had a massive sell-off because the price level was unsustainable. It was erratic and it was irrational because of the short squeezes, but there still could have been a large profit to be taken here. Of course, again, this went down like 65%. So because it was an erratic price movement, but even with that said, this was a large movement that could have been taken. So you're just gonna really want to watch out for these. Some of these hype stocks, you might think, "Oh, well, it's hyped, so it's going to go down. There's not the great fundamentals backing it. However, if there's enough buyers, even if there's not great fundamentals behind the stock, there's enough buyers willing to buy it, it's going to keep increasing the price. Because a lot of people, if they're just retail investors, they don't know about the fundamentals. They're just hearing all this hype about, Tesla or stuff like that. Um, so they're just going to keep buying, and you think, well, this has got to go down. It's not worth this. But that might not necessarily be the case. The market can be irrational longer than you can stay liquid. Um, so this irrational, erratic price movement is just going to be compounded. So, if you try to short this because you think it's all hype and nothing else, you might win, but you also might not. And if you don't, if the price just keeps going up, then you're eventually going to have to cover your shorts. You're going to have to, which means exit your position, which means buy. So then you're just going to compound. You're going to become another one of the buyers. Um, and then that increases the price even more. So this is definitely something to watch out for when you're trading, and something you can certainly take advantage of. Again, please like, share, and subscribe for more. This is Andrew Pardo from Pennant Players signing out. Stay green.